We heard from April earlier about how it is a haven play. We're seeing traders gravitating towards gold, towards dollar, towards treasuries. What is the ultimate hedge against geopolitical risks in the Middle East right now?
Well, firstly, thank you for having me here. And I think what you're seeing is undoubtedly a rapid move away from risk assets. Risk assets during the course of this year have accreted substantially. And you're seeing even this morning with elevated geopolitical risk in the Middle East that has been evident over the course of the last 4 months, 5 months, really come to the fore. Where are investors moving? And I think it's very important, they're defaulting to safety. You've highlighted a number of them this morning. Gold has been up over 20% during the course of this year. It's acted extremely well. Energy continues to be a place where clients are migrating capital to actively with significant velocity. But then you also have to look at commodities, because this is causing a massive break in supply chain concerns. And I think you'll see a continuation of that concern evolving during the course of the next 4 or 5 weeks as more details come out of what's actually happened today. But in aggregate, I think you will see this flight to safety continue and a deflation of risk assets that we've seen really since the start of this year.
Stephen, how do you reflect all of that in your portfolio, bearing in mind, if you take a look at treasuries and where yields are headed, and bearing in mind as well that tensions are likely to escalate from here?
It is, look, I think what you're seeing is now a move to geopolitical away from central bank divergence, and that migrates week to week. Obviously, over the course of the last 6 weeks, you've seen a huge shift in where the Fed are looking to move. You've had 3 prints of CPI that are difficult for the Fed, and I think you've now got this huge anticipation that started with 7 cuts this year, migrating to very possibly 1 or 2 for the balance of this year. You have the central bank in Europe articulating a clear path to begin that reduction in interest rates in June. So this central bank divergence has been right at the forefront of clients over the course of the last 6 weeks in particular. If you look at how geopolitics emerges and lessons in that framework, I think today's events are demonstrating a huge risk-off awareness. But that risk-off awareness has been underway for a number of weeks. We were talking earlier in the show about volatility in energy. Actually, equity vol is up 40% this year. So you've seen equity markets begin to anticipate, given the accretion over the course of the last 3 months, some elevated level of concern. And that's been reflected again this morning.
And oil at $90 a barrel, some saying could get up to 100, perhaps even 120. Bearing in mind what the IMF said overnight, if we see a 15% upside in oil prices, we'll see inflation up 0.7%. How will that shape the thinking of the Fed and where it goes from here?
Well, it's extremely important for the Fed. And I think, energy prices are a major contributor, as you know. I think, nothing impacts U.S. citizens more than the price of oil, given the price of gas at the pump. And I think that will be of major concern, not only for the Fed, but the political system in the U.S. I think, however, I go back to what you've seen over the course of the last 2 years with geopolitical events, events in Ukraine, events this year, last year in the Middle East, real concerns about supply chain. The nearshoring of assets in the US in particular, the friendshoring has been a massive theme. And I think you'll continue to see this impact on supply chains in particular also be a factor in commodity prices. The price of copper up substantially this year, the price of aluminium up substantially this year, all, by the way, within the context of a very weak Chinese economy, which is truly extraordinary. So I think you're seeing not only geopolitical events come to bear, but you are seeing this very significant change in supply chain and supply chain management be a material issue.
You talk about higher vol, even for equities. What are you advising clients to do? And what are you hearing from your clients? What's happening with their risk appetite? Is it higher, or are they hedging against risk?
Well, you saw a number of clients at the start of this year move very, very consciously into equity assets. And you saw that through the lens of what is going on in Japan. The Japanese equity market rallied over 20% this year. Obviously, you've seen a compression in the course of the last 4 weeks, but that was reflected in most major equity markets. If you look at what was going on in the US, the S&P traded up to 10%. People were trying to find growth, so they were becoming very comfortable with the inflationary cycle coming down. If you look at what the Fed's anticipated moves were, and I highlighted earlier, 7 moves anticipated towards the end of last year, that all gave a huge amount of comfort in equity risk. So you saw equity markets rally very significantly at the start of this year. Actually, I thought they were extremely resilient, but investors were desperately trying to find growth. And I think that that will continue to be a theme over the course of the next 6 months, with the caveat that you now have these very substantial events that are interrupting risk awareness.
And for Barclays, how are you boosting ROE at a time when you're also kind of like downsizing? It's a lean organization.
Well, I think Venkat laid out very clearly a statement with an Investor Day on the 20th of February. That statement was to demonstrate a simpler, more balanced business in Barclays. We have an investment bank that is very diverse across asset classes, across the macro business, the equity business, the credit business, and the securitized products business. So we're very diverse from a product perspective, capable of transacting for clients across the entire asset class spectrum. Secondly, we're also very diverse from a geographic perspective. I'm here in Asia this week. And we've had more than 50 years of relevance here in Asia, big business in India. Perhaps we'll talk about that later. But so we have a diverse portfolio of businesses within the IB, very capable of providing solutions in positive risk awareness and negative risk awareness.
Stephen, before we go for a very short break, just to touch on currencies, we've seen a fallout in Asian currencies on the back of the really resilient USD. How do you see this playing out?
Look, a strong US dollar is difficult for a number of people. You now have China and the US in very divergent positions from an economic perspective. You have weak equity markets in China. You have weak employment markets in China. The last thing they want is a weak currency. You have huge dollar strength. It's the default asset of safety. And a Fed that is now looking like it is going to reduce rates at a far slower rate than was previously anticipated. So I think that a strong dollar ultimately is problematic. It's very problematic for emerging markets, as you know. And I think that until we get clarity through this geopolitical issue, I think the dollar is going to continue to remain strong.